Hi everyone, I'm Ali, and in this video I'll talk about the Auditor Independence. Auditors are required to adhere to APES 110 requirements for independence. We talked about the APES 110 in the previous videos. Independence is the ability to act with integrity, objectivity, and with professional skepticism. For example, the auditor will be considered as an independent person if the auditor can act with integrity, objectivity, and with professional skepticism. Financial reports must be relevant, reliable, comparable, understandable, and true and fair. It is the responsibility of those charged with governance and the board of directors to ensure that these requirements are followed. It is the responsibility of the external auditor to form an opinion on the truth and fairness of the financial report. If the auditor is not independent of their clients, it will affect the credibility of and the reliability of the financial report. The financial report users must believe that the external auditor is independent of the company that they audit. According to APES 110 section 400.5, there are two forms of independence. These are independence of mind and independence of appearance. Independence of mind is the ability to act independently, the ability to make a decision free from bias and personal beliefs and client pressures. It allows an individual to act with integrity, objectivity, and professional skepticism. This is also sometimes referred to as actual independence. Independence in appearance is the way an auditor seems to others when conducting an audit, and whether others believe that the auditor looks able to make decisions using appropriate level of professional skepticism, integrity, and objectivity. In particular, the auditor should be avoiding facts and circumstances that are so significant that a third party would conclude that integrity, objectivity, or professional skepticism has been compromised. The Code of Ethics of Professional Accountants identifies 5 key threats to auditor independence, and these threats are self-interest, self-review, advocacy, familiarity, intimidation. In the next few slides, we'll discuss these in details. Self-interest threat. This can occur if the audit firm or its staff have financial interest in the audit client. Some of the examples I've listed here for you to help you understand this. If an audit firm or its staff owns shares in the client, if the audit firm has fee dependence, this means where the fees from assurance and other services from a client form a significant proportion of total fees of the firm. That is, the audit firm is reliant on that client because the fees are so high that it earns from them. And another example is where the audit firm or staff has a close business relationship with the audit. Self-review threat. This can occur when the assurance team need to form an opinion on their own work or work done by others in the firm. So that means, for example, if an assurance team member has recently been an employee or director of their client and they are now auditing their own work. So the information that has been prepared for the client that is then assured and audited. But in actual fact, these services that are being assured, examples for a self-review threat. Another example is issuing an assurance report on the effectiveness of the operating of financial systems after implementing those systems. Advocacy threat can occur where a member will promote a client's position to the point that compromise the member's objectivity. Some examples where advocacy threat can occur are listed here. For example, encouraging others to buy client's shares or bonds and representing the client in a legal dispute, or with third party will create an advocacy thread. Familiarity thread. This can occur when a close relationship exists or develops between an assurance firm and the client, or between the firm and the client personnel. As a result, assurance staff can become too sympathetic to the client's interests or too accepting of the client's work and could lose objectivity. For example, a situation where a close or immediate family member who is a director or officer of the client. Another example is a director or officer of the client having recently served as the engagement partner, or an audit team member having a long association with the audit client. The last thread that we need to talk about is intimidation thread. This can occur when a member of the assurance team feels threatened by the client's staff or directors. As a result, the assurance team member then is unable to act objectively and fearing negative consequences. So what is an example of a negative consequence? The client may be exerting undue pressure on auditor to do something, or perhaps not to do something, or perhaps to reduce the audit hours or reduce the fees paid. And the threat is that the client will not re-employ auditor if the audit does not meet the demands that the client have requested of the auditor. Another important area to consider in auditor independence is safeguards to independence. These safeguards are created by the profession, the legislation or regulations, and the important standard that you should refer to is ASQ C1. This rather a long name, but it refers to quality control that the auditing firm needs to be aware of. So the name of these standards is Quality Control of Firms that Performs Audit and Reviews of Financial Reports and other financial information, other assurance engagement and related services engagement. A big mouthful, I'll refer to as ASQC1. The further standard that you are already partially aware of that standard is the Code of Ethics, APES 110. Auditors also need to be aware of the legislative requirements to be independent. As an example of that is the external auditor is required to include an auditor's declaration in the annual report of their client stating that they are in fact independent of the client. And also there are Corporation Act requirements. An example here is that a retired audit partner must not take a senior role in an audit client for 2 years. There are also safeguards to independence which are created by the client. So the clients will have established policies and procedures and corporate governance requirements. So for corporate governance, an example could be the establishment of an audit committee. An audit committee is a subcommittee of company's board of directors. It liaises between the external auditor and management. An effective audit committee helps in enhancing the independence of the external audit functions of a firm. The corporate governance aspect refers also not only to the establishment of an audit committee, but also to the appointment on and removal of the auditor. Client can ensure that the responsibility for the appointment and removal of an auditor rests with the independent directors on the audit committee or the board of directors. Policies and procedures are implemented because the auditor needs to have access to all required documents and records. So the client can ensure that there is an appropriate system in place which can make sure that the audit team members can obtain the information that they need to be able to complete the audit work they are required to do in order to give an opinion on the financial statements. Safeguards are also created by the accounting or auditing firm themselves. This means the different quality controls procedures that auditing and accounting firms will have, and that will include things like provision of professional development for staff, partner rotation policy to ensure independent from the client, peer review of audit work files, and also client acceptance and continuance procedures to ensure any threats to independence are identified on a timely basis. So for this section, what you need to be able to understand is why an auditor independence is important. So can you explain what the threats to auditor independence is and that need to be considered? Right, that's the end of this video. In the next video, we'll look at the relationship between the auditor and other key groups. Thank you.